Okay, so a few years ago, inflation became one of the biggest economic stories in America, and it continues to dominate a lot of headlines today. And if you've paid attention to the news at all, you've probably heard some level of explanation. Too much money chasing too few goods. People got stimulus checks, interest rates were near zero, everybody started spending more. Prices went up. And when prices go up, the Federal Reserve raises interest rates to cool things down. That's the story. And to be clear, there is a lot of truth in that story, and I've talked about different parts of it before. But I also think it's incomplete. Because if inflation was simply caused by people spending too much money, then why did some of the biggest price spikes happen in places where we physically couldn't produce, ship, or deliver enough products? Why did used car prices explode when semiconductor factories shut down? Why did food prices surge when fertilizer prices surged? Why did energy prices spike after a war broke out? Why did furniture take 6 months to arrive? Why were cargo ships sitting outside ports waiting to unload? Those are not demand stories. Those are supply stories. And I think one of the biggest economic mistakes we can make is treating inflation like it was the disease itself. Because inflation isn't actually a disease, it's a symptom. It's like a fever. And if you've ever had a fever, you know something important. The fever isn't actually the problem. It's your body telling you that something else is wrong. Now, it's uncomfortable, but it's not the main thing. So today I want to talk about what the main thing was, because I think understanding it explains why inflation was so stubbornly high for longer than the vast majority of economists anticipated, and why the economy has felt so strange for the last several years. So let's get into it. Let's start with the basics because there are two very different ways that inflation can happen. And this distinction is going to matter a lot for everything else I'm going to say today. The first type is called demand pull inflation, and it is the classic, more well known story. Consumers are spending aggressively, businesses are investing heavily, governments are putting money into the system. The economy is producing at full capacity, but demand is still outpacing it. Too many buyers chasing too few products. Translation: everybody wants it, there's not enough of it, prices go up. Pretty simple idea. And the policy fix for this one is very well established. The Federal Reserve raises interest rates, so borrowing gets more expensive, spending slows down, the economy cools off, inflation comes back down. The framework has worked many times throughout history, and it is the foundation of modern central banking. Now, the second type is where things get more interesting and a little more complicated. It's called cost push inflation, and this one works completely differently. Instead of demand going up, the cost of actually making and delivering the goods goes up. Energy prices rise, transportation gets more expensive, raw materials become harder to obtain, workers become harder to hire. Businesses aren't selling more stuff, they're just paying more to produce the same stuff. And who do those costs get passed on to? You and me. They get passed on to the consumer. And the end result looks similar. You feel it at the grocery store, at the gas pump, when you try to buy a car, but the cause is fundamentally different. So let's take it this way. Imagine there's a major drought, worst in a generation, and it wipes out most of the wheat crop in a country. What's going to happen? The price of things that rely on wheat to be produced, like bread, for example, are going to go up significantly. But is that because consumers suddenly decided they wanted more bread? No, it's not a demand issue. It's because the supply itself became constrained. That is cost push inflation. And the prescription to fix it is a completely different conversation. So, why does this distinction matter so much? Because the conventional response to inflation, raise interest rates, works most directly when inflation is being driven by demand. If your prices are going up because there's a drought, raising interest rates does not make it rain. It does not grow more wheat. It doesn't put bread back on the shelf. Now, to be fair, by raising interest rates, which typically reduces demand, that can still lower inflation because fewer buyers are competing for those more limited goods, but it's an indirect response and it may not have the same effect. So, the question I think we should have been asking from the beginning and largely weren't asking loudly enough is, which type of inflation is this? And when you actually look at the timeline of everything that happened over the past several years, the answer is more complicated than a lot of talking heads have suggested. And here's why it matters for you specifically. You might be thinking, well, okay, inflation is inflation. It being a supply issue or a demand issue still results in the same thing, things being more expensive. Does that really matter for me? I'm going to argue that it actually does. If a significant portion of this inflation was driven by supply side vulnerabilities, by systems that were outside consumers' control, and if those vulnerabilities are still present, then we should not be sitting here feeling like the problem can be fully addressed purely through central banking or government policy. We should be thinking about what comes next in reality. So let's actually walk through what happened. Four supply shocks that affected the global economy starting in 2020. In early 2020, as I'm sure none of us need a reminder about, the global economy essentially shut down. And I don't say that as hyperbole. Factories closed production, ports backed up with hundreds of cargo ships sitting offshore waiting. Shipping routes were completely disrupted. Millions of workers went home, and entire industries basically went into hibernation. And this exposed something we had been quietly ignoring for years. It's an inventory strategy called just in time supply chains. The practice of ordering things only when you need them, keeping zero buffer of inventory, maximizing efficiency. Just in time supply chains suddenly looked extremely fragile, far more fragile than anyone realized was even possible. There was no cushion. When one piece of the system stopped, there was nothing backing it up. There was no safety net in our global supply chains. And the results showed up incredibly fast. Used cars became nearly impossible to find because the semiconductor chips that go into new cars weren't being manufactured. Building materials skyrocketed. Anyone who tried to do a home project knows that. Appliances were backordered for months. Furniture orders stretched to a year. These were supply side failures. And in response, many global suppliers and companies have pivoted to a completely different inventory strategy post COVID, known as just in case supply chain management, which is basically the opposite idea. Companies maintain sizable buffer stocks to prevent supply issues or broad shortages. It's obviously understandable why people have made this shift, and it definitely looks to be the safer bet, but there's a pretty clear consequence: higher costs to companies, putting upward pressures on prices. What does that mean? Consumers pay more. Shock number two: labor shortages. As economies started to reopen, businesses expected the workforce to come back in full. Many did, but not all of them, and not quickly enough. Truck drivers became harder to find, manufacturers couldn't fill their production lines, restaurants ran with skeleton crews. Healthcare systems, already stretched to the limit, understandably, were facing critical staffing shortages. Warehouses couldn't hire fast enough. Labor became scarcer. And when labor becomes more scarce, it becomes more expensive. And when labor becomes more expensive, the cost of producing everything goes up. And those costs, once again, flow downstream directly to your receipts. And now it's worth noting some labor shortages have eased considerably, but labor markets in several critical industries like manufacturing and healthcare remain tighter than they were before the pandemic. So while it's not as bad as it was a few years ago, this is still not a closed chapter. Shock number three: Russia and Ukraine. In February 2022, Russia invaded Ukraine. This is kind of a side note on the geopolitics, but the economic cascade matters here, and I don't want to skip it. Almost immediately, oil prices surged in certain areas. Natural gas prices surged in certain parts of the world. Fertilizer prices surged because fertilizer is largely produced from natural gas. And then food prices surged in some places. Russia is one of the largest energy exporters. Ukraine and Russia together account for significant portions of global grain exports, agricultural commodities, fertilizer production, and that's not a small disruption. That's a fault line. Here's why the ripple effect of that is so significant. Energy affects everything. We've talked about that before. It affects transportation, and transportation affects manufacturing, and manufacturing affects consumer goods. Fertilizer affects food production. Food affects every single household budget at every income level everywhere. So what we're looking at is not one shock. We're looking at three overlapping shocks hitting a global economy that had optimized itself for efficiency rather than resilience. And then we have shock number four: the Strait of Hormuz, the shock we are all experiencing in real time right now. The first three shocks I just talked about are past tense. Supply chain recovered slowly, imperfectly, but it did recover. Energy markets stabilized for a time, labor found a new equilibrium, but here's why this conversation is not just about history. On February 28th of this year, Iran effectively closed the Strait of Hormuz. That is the narrow waterway, roughly 21 miles wide at its tightest point, connecting the Persian Gulf to the rest of the world's oceans. I bet it's a name that most of us didn't know, but we all know now because the International Energy Agency reported that oil flow through that strait has slowed to pretty much a standstill. And what exactly flows through that strait? Approximately 20 million barrels of oil per day, roughly 25% of all the world's seaborne trade, about 20% of global liquefied natural gas, one strait, 21 miles wide. And we all saw what happened. Oil prices surged by double digits almost immediately. The average price of a gallon of gas in the United States has jumped more than 50% since that closure. I do want to be careful here, though, because the situation is still developing and the global energy trade is a very nuanced and complex thing. I am not going to tell you or try to guess where oil prices will be next month. Oil futures are around $79 as the time I'm recording, which is down from their high of about 112 back in April. But all of that is entirely speculative. What I can tell you is the mechanism, because the mechanism is well established. Oil's not just what goes in your gas tank. We talked about that a few weeks ago. It is embedded in the cost of manufacturing, of shipping, of plastics, of food production, of heating for a lot of people, of electricity generation. When oil surges, everything else follows at some lag. The International Monetary Fund has repeatedly highlighted energy shocks as key drivers of inflation differences across countries. Energy is the cost embedded in the cost of everything else. And here's what I want you to see. This is not demand pull inflation. Nobody woke up one morning and decided they just wanted to go get some more oil. This is a choke point, a single geographic bottleneck that a quarter of the world's seaborne oil supply depends on, and it closed. And the Fed cannot raise interest rates to reopen the Strait of Hormuz. Same limitation we saw in 2021, different choke point, same fragility. Now, setting the current situation aside for a moment, because I want to come back to what it means for you, let me go back to the original inflation cycle and make sure we're being honest about the demand side of the story, because intellectual honesty is obviously very important. I've talked about the demand side before, and I don't want to give the impression that this was an either-or situation. We're dealing with both and. Demand absolutely mattered. I don't want anybody to incorrectly hear me say that this was all supply side and demand was some kind of like red herring. It wasn't. Stimulus payments mattered. Near zero interest rates for years mattered. That's what our last video was about. Excess household savings mattered. Strong consumer spending mattered and continues to matter. And the Federal Reserve Bank of Cleveland has published research showing that supply shocks contributed meaningfully to inflation during the pandemic period. The Bank for International Settlements has also emphasized that supply-side disturbances played a much larger role than many traditional inflation models initially anticipated. But that research also acknowledges that demand-side factors played a meaningful role in sustaining inflation once it became embedded into the system. So this is not a supply-only argument. The honest answer is both were happening at the same time. The supply side of the economy was breaking down just as policymakers were injecting enormous amounts of support into the demand side. One side of the equation was becoming less capable of producing goods, while the other side was being encouraged to keep spending. That's a recipe for rising prices. So the disagreement among economists right now isn't really whether supply mattered, it's about how much it mattered relative to demand. And that nuance matters because it changes how we should think about what's coming and what the economy may look like in the future. We can't predict anything, but we can be sober-minded about what the past could show us about the future. The Federal Reserve raised rates aggressively, the fastest hiking cycle in decades. And I want to ask a genuine question here, not as a criticism of the Fed, but because it's instructive. What exactly are interest rates supposed to do about a supply shock? To put it plainly, the Federal Reserve can't produce more oil. It can't manufacture semiconductors. It can't unload cargo ships faster. It cannot end wars. Its primary tool is reducing demand. We weren't curing the disease, we were managing the fever. But, and I alluded to this before, does that mean that raising rates during a supply-driven inflation episode is irrational? No. If supply can't recover quickly enough, reducing demand may actually be appropriate and potentially helpful because you're slowing down the competition for scarce goods. But here's the distinction that matters. We're not fixing the supply problem, we're compensating for it, and that's very different. We weren't curing the disease, we were managing the fever. And this is exactly why this dynamic is playing out again right now in real time. The Strait of Hormuz closure isn't something the Fed can fix by adjusting the federal funds rate. If energy prices feed into consumer prices over the coming months, the Fed faces the same impossible menu that it faced in 2021. Reduce demand or watch the supply side pressure stay embedded and potentially get worse. So here's where I want to land, because I think this is the most important part of this conversation. The deeper lesson from this inflation episode, the one we should be carrying forward, is this. Our economy is a lot more fragile and a lot less resistant globally than most of us realized. For decades, efficiency was the dominant goal. Companies optimized supply chains down to the day. Manufacturing became increasingly concentrated in fewer places. Inventory shrank. Redundancies were eliminated because redundancies cost money. And it did work. It generated enormous economic benefits. But those same decisions, just like every decision, have trade-offs. And those trade-offs created vulnerabilities. Ports, railroads, energy grids, trucking networks, semiconductor fabrication concentrated in one region of the world. Fertilizer production, a 21-mile wide strait through which a quarter of the world's oil flows, seaborne oil. These are choke points, and most of us didn't really know it until they seized. When everything works perfectly, or the way it's supposed to, efficiency is wonderful. But when they break, resiliency all of a sudden becomes way more important. So inflation was a warning signal. The fever. The fever gets our attention. The fever hurts. But the fever isn't the underlying problem. The underlying problem is whatever causes the fever in the first place. We treated the fever. We haven't quite cured the disease. And one of the reasons this matters for you is because most households have been encouraged to optimize for efficiency too. We are a consumer-driven economy, and so we run our finances the same way companies have run supply chains. For a lot of people, it's no cash buffer, no margin, no slack, and it may work for a time right until something breaks. A lot of my job when I sit down with clients is to show the places that are going to suffer when we don't have those buffers, when there's no margin, no slack, no preparation. Because it doesn't matter what level of income you're at, it will create problems when unexpected challenges happen. And unexpected challenges happen for everyone. And as we come to the end, if you've followed me, you know that I always end with what I call a biblical frame. So we're moving out of the economics discussion and into the framework for people who follow Jesus. Because I genuinely believe our faith has something meaningful to say about how we think about money and risk and the economy and the future. And all of this kept bringing back to mind the story of Joseph in Genesis. You may know it. Joseph was one of the 12 sons of Jacob. His brothers, who were jealous of him, plotted to kill him and ultimately sold him into slavery. And through a series of God-ordained and at times really hard events, Joseph found himself in prison before being summoned to Pharaoh in Egypt. And Joseph ends up interpreting a very weird dream of Pharaohs with fat cows and skinny cows and weird ears of corn, which turns out to be a divine prophecy of 7 years of great abundance in Egypt, followed by 7 years of severe famine. And one of the many incredible parts of the story is how Joseph provides wisdom to Pharaoh past simply interpreting the dream. Joseph doesn't just say, all right, well, good luck with that. If you read through the account in Genesis 41, he both interprets the dream and then immediately proposes a plan for how to handle it without being asked. He tells them, select a wise leader for this upcoming crisis, appoint overseers to stockpile 20% of the produce during the plentiful years, create warehouses to store grain, and keep this food as a reserve during the famine. He builds system, he stores grain during the good years, he creates margin, he builds resilience into Egypt's economy in real time, and he's sober-minded about what the state of things will become in the bad years. And obviously, we don't have dreams to interpret or any sort of divine prophecy about recessions or anything like that. This was a very specific moment in redemptive history to serve a specific purpose in God's overall plan for his people's ultimate good and for his glory. But there is still a lot of beautiful wisdom for us thousands of years removed from this. Joseph's wisdom wasn't simply in interpreting a dream. What also made him wise was that he understood what was coming and prepared during years of abundance for a season of scarcity that was going to arrive. His focus wasn't simply prediction. His focus was resilience. And I think that cuts directly against one of the most common financial mistakes I see: spending energy trying to predict rather than prepare. Most people are asking, will rates go up more? Or when are they going to cut again? Is higher inflation coming back? When is the next recession? What happens if the Strait of Hormuz stays closed for even longer? And those are legitimate concerns, but no one knows for sure. We can't predict when these kind of supply or demand shocks will happen. And even if we could, the severity and scale of inflation and of the economic ripple effects, no one knows. No one knew when the last recession would hit, except for like the four guys that are in The Big Short. Nobody had any idea a crash was coming in 2008, let alone the biggest financial crisis in a century, as much as everyone now has hindsight bias and tries to claim that they knew. Nobody knew. But Joseph didn't spend 7 years trying to predict the exact moment that the famine was going to come. He spent 7 years building the reserves that would carry Egypt through when it did arrive. And these areas of practical wisdom, I think, can often get lost in the spiritual conversation, but there are so many instances in Scripture where we see how God is both ordaining and orchestrating outcomes, and those outcomes are completed through human actions and how God designed the world to work. Preparation matters so much more than prediction. You can play the what if game on anything, not just economics, till you're blue in the face, but it doesn't change anything. But intentionally controlling your choices and having long-term focused absolutely can move the needle. But resilience isn't exciting. I don't think anyone's written a super viral article about the household that just quietly paid down debt, kept an emergency fund, didn't overextend. Like, those stories aren't exciting. But when the next disruption comes, and there will be a next disruption, there always is, resilience is one of the most valuable assets you can hold. But those statements are generally true for everyone. For the believer, preparation and resilience with our money choices aren't the point in and of themselves. We prepare and build in resilience to what end? To the glory and honor of God, and understanding that everything we have is a good gift from Him to begin with. And we can trust His word in accounts of people like Joseph, and in places like Proverbs 8 that describe God's wisdom as better than jewels or silver or choice gold. So if your preparation for harder days or economic shocks is in pursuit of hoarding as much monetary wealth as you can and calling it wisdom, then you've missed the point. Preparation and wisdom in building a resilient financial world should be from an outflow of a heart that knows where true riches are and makes prudent financial choices with a rightly ordered heart, loving Jesus above all else, knowing that money is not ultimate, and our great, far surpassing wealth is in our eternal inheritance that we have been promised and will one day receive from our good and heavenly Father. So as I wrap up, the question I want you to leave with today is not, will higher inflation come back? It's, how resilient is your personal financial system right now? Do you have a buffer? Do you have flexibility? Have you built in margin? If something breaks, a job loss, a medical event, another supply shock that nobody predicted, how long can you hold? Those questions are worth sitting with, and if you're not sure how to answer them, it is absolutely worth a conversation with a trusted advisor who can help you stress test where you actually stand with your real numbers in your specific situation. Just remember, for the follower of Jesus, money is a gift to be used responsibly. It is not our ultimate aim as followers of Jesus, so let's make our money decisions accordingly. Jesus loves you. God is real. I'll see you guys next time.